So the only way, okay, that I can think of right now for you to avoid, basically to avoid, or sorry, not avoid. Again, keep in mind, we're not trying to avoid taxes. That's actually illegal, okay? But pay less taxes. That's the right way to say it, right? The only way to pay less taxes on flipping is to flip that house into your own portfolio, flip that house within your own portfolio. So again, you can hold on to the property for the purpose of renting it out, right? For the purpose of using it as a property, as an investment property. If this is a home that you're keeping as a vacation property, there is limit use. What does limit use mean? I don't know, okay? I don't know. Again, these are some of the questions. So I would ask my CPA about 1031 exchange with respect to flipping a piece of property. If I flip a property and I make $40,000 profit from that, how much taxes am I going to be owed? How can I reduce? Is there a way to pay less taxes on flipping houses? All right, so that's a good question. Now, first of all, I am not a tax advisor. Okay, let's make that clear. I am not an accountant. I'm not a CPA. I'm not a certified accountant in any way. Okay, so take anything I tell you with a pinch of salt. I'm just going to give you my insights based off of experience and based off of what I know when it comes to flipping houses. Is there a way to pay less taxes? Now, the one familiar way I can tell you right now is to flip the house into your own portfolio. Okay, flip the house into your very own portfolio. What do I mean by that? Okay, so there's something called capital gain. Okay, when you buy assets and you sell it within the same year, you will pay capital gain taxes. Okay, and there's also ordinary income taxes. Okay, basically the taxes you pay on any type of income, right? But when we say capital gain taxes, basically you invested a lump sum of capital and you sold the asset and you made profit. There's capital gain. So standalone, you will pay taxes on that property. Okay, so now here's what I can tell you. If you work with a CPA, okay, if you work with a CPA, especially if you've done enough of this, if you've done only one of this in any given year, at some point it may not be worth it to you for you to go pay $2,000, $3,000, $5,000 for a CPA. Okay, so but again, talk to a CPA and see if it's worth it for you, because I cannot determine that for you. What I can tell you is that a conversation with a CPA will go a long way. Okay, so now with that being said, okay, like I said, there's capital gain taxes, there's ordinary income taxes, and if you want to avoid capital gain taxes legally, it's probably a good idea to start looking into things like 1031 exchange. It's called 1031 exchange, and basically I don't know the technicalities of it up till today. Every time I really need to do it, I could go literally, which I'm about to do right now. I can go onto Google and look at what the Google definition says, and then I can probably share that with you. But basically what I can tell you is this, okay? In real estate, like this is the definition on Google right now. In real estate, a 1031 exchange is a swap of one investment property for another that allows capital gain taxes to be deferred. So capital gains are not eliminated exactly, they're deferred. That's the difference, right? An exchange can only be made with like kind of properties, okay? And IRS, which is Internal Revenue Services for United States, rules limit use with vacant properties. So if it's a vacant property is not occupied, there's limit use, which means you cannot use the same tax advantage over and over when there's a vacant, sorry, not vacant, see, vacation properties. Okay, so you bought a second property somewhere, second home somewhere on the beach somewhere, that will not probably limit use. They said limit use at some point will not qualify for 1031 exchange. Okay, but the idea here is that it has to be investment property. That's the key thing, and it's a way for you to push capital gain taxes. You push it forward, okay, and pushing it forward There's also a place where it becomes where you kind of like don't have to pay for it legally. Okay, again, that's why I said talk to a CPA. Okay, a lot of times when people say 1031 exchange, they say eliminate or avoid taxes. That's usually never the case, right? In the grand scheme of things, it can become avoiding taxes altogether because there's function of time. There's also function of different things going on in your different individual portfolios, right? But like I said earlier, the first thing I want to tell you is that when it comes to flipping a property, which is usually by definition, what that means is by definition, you are selling an asset within the first year that you actually purchased it for a profit. That is capital gain. Okay, it's the same thing that you will realize when you do the same thing in a stock market, right? A piece of paper asset, you sold it at a profit, you will owe money. Okay, so the only way, okay, that I can think of right now for you to avoid, or sorry, not avoid. Again, keep in mind, we're not trying to avoid taxes. That's actually illegal, okay? But pay less taxes. That's the right way to say it, right? The only way to pay less taxes on flipping is to flip that house into your own portfolio. Flip that house within your own portfolio. So again, you can hold on to the property for the purpose of renting it out, right? For the purpose of using it as a property, as an investment property. If this is a home that you're keeping as a vacation property, there is limit use. What does limit use mean? I don't know. Okay, I don't know. Again, these are some of the questions. So I would ask my CPA about 1031 exchange with respect to flipping a piece of property. If I flip a property and I make $40,000 profit from that, how much taxes am I going to be owed? How can I reduce such taxes? Is it possible to write off certain expenses against this? Keep in mind, capital gain is called capital gain because you've already factored in all of the expenses that goes into flipping the house. So for example, the cost of the contractor, the cost of buying things at Home Depot, right? The cost of driving back and forth from the project, right? All of these different things would have been factored before you call it capital gain. And then that capital gain, you do have to pay taxes on it. In order to not have to pay taxes on it, you can retain it. That's what I mean by flipping it, okay, into your own portfolio. You retain it and for your own portfolio, and then you can legally pay less taxes because then you can offset, defer on the capital gain taxes into the future up to a point where things can easily cancel each other out over time. Okay, so this is on Investopedia here. It says in real estate, 1031 exchange, a swap of one investment property for another has to be similar. Investment properties only. Okay, the term, which gets its name from the Internal Revenue Service (IRS) section 1031, okay, is bandied about by realtors, title companies, investors, and soccer moms. Some people even insist on making it into a verb. Let's 1031 that building for another. That means you swap it for another. So here's the part that I'm probably missing out a little bit, and I want to make sure I stress on it. When you sell one and you use the profit to buy another one within the same period of a year, not only do you pay less taxes, you push any leftover taxes over to the next year over, while you're using your profit to continue to build your portfolio, your assets, and your net worth. Does that make sense? So instead of keeping that, if you keep that money in your account and December 31st this year, the profit you made, the capital gain, if it's in your account and December 31st this year, you now have to pay taxes on that. But if you use that money to buy another piece of property and do another project that you will still be within that project on December 31st into the next year, you defer that taxes. And by deferring that taxes, you can potentially absolutely pay less taxes over time, if not completely avoid taxes by just so doing. But again, please make sure you talk to a viable professional CPA to make sure that you're clear on that. But I just wanted to sow that seed in you and to make sure that you know that these things are absolutely